Streaming from Oklahoma's own digital studio, this is Dave Davis with Your Money Matters.
Hey everybody, thanks for clicking on to the Oklahoma's own original YouTube page as we're going to get your new home for the Your Money Matters segment is the Oklahoma's Own Originals YouTube page. I'm Dave Davis. We're here outside of the newscast after our 5.5-hour broadcast. On Monday mornings, I'll often speak with experts and all kinds of folks around the Tulsa area and nationally about what's going on with our economy and how does that relate to you. If you're struggling to pay your bills, if you're not struggling and looking to maybe invest, something for everyone here. So Steve Wyett with BOK Financial, one of our guests, longtime guests as we started this Your Money Matters segment about a year ago now, and Steve has been on with us a lot. Steve, good morning. How are you doing?
Dave, fantastic. Thank you so much for having me on. Boy, there is a lot for us to cover. I'm excited about having our conversation today.
Yeah, I am too. We're recording this early November of 2025. If you're watching maybe 6 months from now, a year from now, we're recording this heading into the holidays. And just generally, how is it looking economically for folks who are going to start ramping up to start buying Christmas presents and getting ready to travel on the holidays and trying to make all the money work for that?
Yeah, Dave, you know, it's one of the great things about U.S. consumers. They always seem to find a way to spend money. But as we enter this period, man, there's some real headwinds for U.S. consumers that we need to be concerned about a little bit. One is of the government shutdown, and I know we'll want to talk about that more often, but that not only does that impact those that are directly impacted by the government shutdown, it just causes concerns everywhere else. But the bigger thing really, Dave, is that the job market is definitely a little bit slower now than what it has been in the past. This is why the Fed's lowering interest rates at the present time. They're a little concerned about the weakness in the job market. Historically, once unemployment starts to go up, it tends to go up relatively quickly. So they want to do what they can to avoid that. Now, unemployment's still at 4.3%. We are seeing some layoff announcements increase, but let's remember that the size of the job market or the labor force in the U.S., about 170 million people. So we haven't seen that really reflected in the unemployment reports. But having said that, the last two have been delayed. So the way Fed Chair Powell kind of put it at the last FOMC meeting, this is like driving in a fog. There's a lot of uncertainty even from the part of the Fed about what to do. But if they're just trying to manage risk, what they're doing right now is trying to add a little bit of a cushion against unemployment going up higher. That would be a negative, particularly as we enter the holiday season. And we're much more optimistic as we think about getting into 2026. But right in front of us, just a lot of headwinds and reasons for consumers to be cautious, I think, at this point in time.
Yeah, and we see what you were talking about here, Steve, and we'll go over all of this, starting with the inflation. So 3%, slightly below projections, would you categorize it as inflation cooling down, slowing down a little bit? How would you categorize it before I start putting adjectives on it?
Yeah, what I would say is in the last 3 to 4 months, inflation has been pretty stable. It's not going up a lot, but it hasn't come down. You're correct. When they announced that, and I think it's important to note, the reason that we got a CPI report a week ago last Friday, from the Department of Labor, it shut down like everything else. But this month's CPI report was important for setting the cost of living adjustment for Social Security recipients for the next 12 months. So they brought them back to the office to get this number out. 40% of what the numbers they looked at, they were imputed. That means they guessed because they didn't have all of the data that they were looking at as well. But that CPI number at 3%, we were thinking it might be 3.1. So as you mentioned, a little lower than expectations. That actually led to a bit of a rally in the stock market and put the Fed in a position where they felt like they could go ahead and ease monetary policy. But Dave, I got to tell you, that means that the path towards 2% has slowed down. We were seeing some pretty good movement in that direction. But in the last 3 or 4 months, some of this is due to tariffs. We're seeing that impact out there. We are getting some relief in some of the shelter components of the CPI, which is coming down. but it's still a long ways from the Fed's 2% target, Dave. So I think inflation has been stable. It's not getting worse, but it's not getting a lot better. And as you and I have talked about before, even as inflation rates come down, that does not mean prices are falling. That means they are going up more slowly than they were before. And so the pinch on consumers from inflation is still there.
And when we talk about interest rates, because as we're going into this holiday season, so the federal shutdown, for one, I mean, people are having to take out loans in some cases if they don't have their paychecks, but also if you put things on your credit card in the holidays, as data shows us, a lot of people do, billions and billions of dollars. How does the interest rate affect this season that we're coming up to here, the end of 2025, and the interest rates being cut by 1/4 percentage point at the last meeting?
Yeah, sure, Dave. In fact, the total amount of credit card debt's now over $1 trillion out there. So it's a lot, but our economy's bigger, so that's not surprising to see the absolute number move up. Here's the hard part for credit card debt, Dave. The average rate on a credit card is still well over 20%. So you're right. When the Fed does cut interest rates, you see credit card interest rates come down 25 basis points or so. If you're a corporate borrower, if you've got a prime rate loan, that comes down. If you've got a short-term, there's all kinds of short-term indexes out there. But for consumers, which are primarily their access to quick debt is through credit cards, it's great that it's down 25 basis points. The hard part, that rate is still very high. So I don't think this is enough that if consumers are having to use credit card debt to make ends meet, it doesn't hurt, but it's not going to help you that much. This is still a scenario where those interest rates are very high. Where it does impact also, Dave, if you're a saver, this reduces rates on CDs and overnight cash. So how we feel about interest rates probably depends on whether you're a saver or a borrower. As a saver, I want higher interest rates. As a borrower, I want lower interest rates. But I don't mean to sound particularly negative, but for consumers accessing short-term debt with credit cards, that's still a very expensive way to borrow money.
In a way that if you can avoid it, certainly do. Cutting back on Christmas, different things that you can do of like, hey, maybe this isn't the year that we go big on Christmas. Maybe this isn't the year that we travel and go see family, and maybe family comes to us if you're young children and things like that. I know I've been in that with my situation where my parents are in Ohio, my in-laws are in Missouri, and sometimes it's like, hey, us traveling with 2 children, that's 4 airplane tickets. What if you 2 came here? Just little things that you can do, or like, hey, there's a couple years there, my sister and I didn't do Christmas presents. Just like, hey, we love each other. Let's just get stuff for the kids. There's ways that we can do it, because it's interesting, Steve, as we're talking about the holidays too. There's also people, and I know it's not the entire economy, but there are people without jobs right now who are furloughed. How are the furloughed workers, how is that playing in to the economy, as we do have several federal jobs, obviously many federal jobs?
Sure we do. Yeah, and it's, look, I'm supposed to be on a plane tomorrow, and I'm a little worried about what that may mean from an FAA or a TSA standpoint. I've been traveling the last couple of weeks. So far, no big issue, but the longer this shutdown goes, Dave, just the more material the implications are. Now, the reality of it is when they get it worked out, and they will, then the people that are not getting paid will get that back pay. They'll catch that up. But in the short run, man, that really creates a lot of budgetary issues when you still have rent and utilities and car payments. That's not taking a time off, right? So I think this is where, for most of us, Dave, as we think about the government shutdown, it seems to be so self-inflicted. And from that standpoint, it's just very frustrating. It doesn't matter from the political standpoint. Just as a consumer, as an investor, you just look at this and go, man, this is just really frustrating. It reflects a bit of a dysfunctional governing process that I think for all of us can feel like it's not in our best interests as we move forward. They're going to get it worked out. So the longer term implications for the economy are not that great. This isn't going to have a major impact. The shutdown's not going to be what would trigger us to go into a recession. That's not what it's going to mean. But just the longer that it goes, the bigger issue, Dave, you guys have been reporting on this. It's SNAP. It's the Supplemental Nutritional Assistance Program. We're talking about people that not just don't getting paid for their jobs, they're not getting the food assistance that they need. And so we think that political pressure is going to ratchet up pretty quickly here. I would be surprised if the government shutdown isn't solved by sometime this week. It's the 34th day today. The longest one in history has been 35 days, so we'll hit that tomorrow. I don't think they're going to get it solved today. So we're probably going to go through the longest government shutdown we've ever had. It just does not feel good. It doesn't feel like this is the best path forward. So hopefully we can get to some middle ground and get the government reopened, get supplemental nutrition back on track, and get the people that are without jobs now paid so they can take care of their bills.
Yeah, there's just a lot of, as we always talk about, Steve, there's a very complex economy, and this is just now one more layer. For a while, it was like, okay, what's the new tariffs and what's going on here? 100%, 20%, minus 10%, and now we've got the shutdown and just always these extra layers to economies in this complicated global economy. In terms of folks watching right now, what can we expect in 2026? I mean, 2026 starts here. It's hard to believe, Steve. End of the year already, 2026, 2 months from now. My goodness, what is the outlook, just briefly here, for 2026 as folks are maybe looking forward, waiting for this year to end?
We're optimistic moving into 2026. And as we think about consumers, they're going to get a break as we move into next year. Remember that we extended the Tax Cuts and Jobs Act. We added some sweeteners on there, no taxes on tips, overtime, $6,000 income deduction for senior citizens, but they didn't change the withholding schedule for 2025. So what that's going to mean for consumers is that the tax refund period, primarily February and March of next year, we're looking for consumer tax refunds to be up 35 to 45% above last year. So consumers are looking at the potential for a much bigger refund season. Now, let's just hope that that can help lead to some additional spending because we've got all the shutdown and all that stuff taken care of. But that gives us some sense of optimism there. And then for companies, this is really where the big thing is, Dave, with all of the capital expenditures going on because of AI. What all that means is that filters through the economy. A lot of, not just AI, but a lot of tax incentives for companies to continue to expand production and manufacturing facilities here in the United States. We're seeing that investment take place. So candidly, we're looking as we move into 2026 and beyond, we're thinking that economic growth can actually accelerate a little bit from there. So these are near-term headwinds. And I would say this, Dave, if you look at the stock market, and we've shown data that has shown the performance of the stock market during past shutdowns, and it really just shows stay with your plan. Don't make any big changes to your investment plan. But the stock market's at or near record highs, Dave, so it's looking through this shutdown. It's looking into next year, and it's saying, man, things could get better. Earnings expectations are going up. And so if I'm an investor with a little bit longer term outlook, it's not the shutdown that I'm concerned about. I've got the Fed lowering interest rates, and I've got tax policy on my side moving into 2026. And I think that warrants somewhat higher asset valuations. That's what we're seeing reflected in the markets today.
And I think that's a great point about the tax refunds. And one of the reasons I wanted to ask you that last question is because maybe this is the time where you start going through your receipts. Maybe this is the year you get a tax preparer instead of doing it yourself, worth maybe the extra money for you, because with all these tax opportunities, this especially just feels like that year, Steve, where you don't want to miss on refunds. You don't want to miss out on deductions. You don't want to miss out on things that could get you hundreds of dollars, if not more. Is that kind of how you're feeling? Just taking this time and say, hey, make sure I get my receipts, make sure I have everything in order for tax season.
Yeah, absolutely, Dave. Look, and we, as you go through these changes, if you think about how you did your taxes last year, you need to make some changes this year. There are different things that you need to look at. There's some different reporting that you need to do, to your point, which could be worth thousands of dollars for you. So whether that's a professional tax preparer or making sure that the software that you're using is asking all the right questions and that you have those receipts and your W-2 so you can look at what that income looks like and make sure you get the maximum amount of benefit from the tax extension that you can. This absolutely is one of those periods of time. There were a lot of changes, so it's just going to be different than what we've done over the last couple of years. Be careful, but I would go into that optimistically. Like I said, there are more benefits from this extension than what we had in the past, and I'd love to see taxpayers get the maximum amount of the benefit from the tax law the way it's written.
Steve Wyett with BOK Financial, Chief Investment Officer. We thank you so much for your time. We always appreciate you having on this program and coming on and talking with us about all just really important topics and a lot going on. So Steve Wyett with BOK, thank you so much for being with us today.
Dave, thank you. Really appreciate it. Stay optimistic, brother. The best is yet to come.
Yeah, absolutely. We will see you next time here on the News on 6 Digital Studio on Oklahoma's Own Originals YouTube channel. Thank you, Steve.
Thank you for watching this Oklahoma's Own digital studio stream. Stay with News on 6 online and on television anytime for the latest news, weather, and sports.